Day trading options. A race between gamma and theta. Here's what actually matters before you blow up.
Day trading options is one of the highest leverage things a retail account can do. It's also one of the fastest ways to blow itself up. We'll get to the single most destructive habit in this game later, but first, the rules of engagement. Same session open, same session close. You don't exercise, you don't hold the expiry. You buy a contract, the underlying moves, you close. Before the bell or before the contract expires worthless. In a US margin account, this triggers the FINRA pattern day trader rule. 3 day trades in a rolling 5 business days under $25,000 of equity. Cross that and your account gets flagged. 2 things people miss. Multi-leg strategies count by round trip, not by leg. Open and close a vertical spread same day, that's 1 day trade, not 2. And the counter is shared with your stock trades, 3 total, regardless of mix. Cash accounts dodge PDT, but settlement quirks lock up your capital, and most option strategies require margin anyway. So for almost everyone, you're either trading inside that 3 trade limit, or you're above 25,000. Decide that first, everything else flows from it. Now the engine. 3 Greeks matter intraday: delta, gamma, theta. Vega and rho, those are longer dated problems. Delta is how much the option moves per dollar move in the underlying. An at-the-money call is roughly plus 0.5. Move SPY $1, the option moves 50 cents. Gamma is the acceleration. It's how fast delta itself changes. Gamma is highest at the money and on short-dated contracts. Theta is the time decay. Every minute the clock ticks, premium drains out of your contract. Theta accelerates as expiry approaches. On a 0-day to expiry contract, it's brutal. Here's the mechanic that confuses everyone. A short-dated at-the-money option has high gamma and high theta at the same time. So your day trade isn't really a bet on direction, it's a race. If the underlying moves fast in your direction, gamma wins, you make money. If it chops sideways for an hour, theta wins, you bleed, even though the price went nowhere. This is why time in a trade is expensive on options in a way it just isn't on stocks. Sitting in chop for an hour on a stock costs you the spread. Sitting in chop for an hour on a 0 DTE call costs the spread plus a chunk of your premium. Every minute is a tax. Which underlyings actually work for this? Not every stock with an option chain qualifies. 3 criteria filter the universe. Tight bid-ask spreads, sub 2% on near at-the-money contracts, high open interest, so liquidity exists at multiple strikes, and short-dated expiries, daily or at least weekly. The list that passes all 3 is short: SPY, QQQ, SPX, NDX on the index side, then the mega-cap tech cluster: AAPL, MSFT, NVDA, TSLA, GOOGL, AMZN, Meta. That handful of tickers accounts for the majority of retail options day trading volume across the entire market. Why is this so strict? Run the spread math. A $2 SPY option with a 5-cent spread costs you about 2.5% per round trip. Annoying, manageable. Now try the same idea on a mid-cap. $1 option, 20-cent spread. You're down 20% before the underlying has moved a tick. The trade is non-viable. The spread ate the edge before the trade existed. Rule of thumb: if you can't see a tight spread on the strike you want, don't trade it. So what do the actual setups look like? 4 strategies fit. Long at-the-money call or put on a momentum break, long vertical spread when implied vol makes outrights expensive, iron condor on a range-bound day, and the headline grabber, 0 DTE momentum. Let me put real numbers on it. SPY trading at 500 on an FOMC day, 9:45 Eastern. You expect a hawkish surprise. The 500 call expiring today is priced at $1.20, $120 per contract. Account equity, 30,000. Risk per trade rule, 1%, $300 max. 2 contracts, 240 in premium, inside the budget. 2 p.m. hits. FOMC announces. SPY rips to 502.50. Your call now trades at $3.10. Deep in the money with a vol pop. You close. Net plus 380. Up 158% on premium. Same exact setup, no Fed move. SPY drifts to 550 by the bell. Your call decayed to 50 cents. Net minus 140, down 58%. Same trade, same size. The only variable was whether the catalyst actually delivered. Gamma gave you the upside, theta took it back, which is why position size has to come from your risk rule, not from what feels affordable. What does this actually cost? 3 cost lines. Commissions, roughly 50 to 65 cents per contract per side at Schwab, Fidelity, Interactive Brokers, 0 at Robinhood. Then the spread, a few cents on liquid names. Then slippage, feels slightly worse than the displayed price on fast moves. Worked example, 2 SPY contracts at IBKR, about $260 in commission plus $6 of spread, $860 total on a $240 premium trade. That's 3.6% of premium. Acceptable. Now the part nobody wants to hear, realistic win rates. 0 DTE momentum scalping, roughly 40% win rate at 2R per win. Defined risk verticals, 55% at 1R. Iron condors intraday, 65% at 0.4R. Random retail with no written plan, negative expectancy. Net loss every month. Most retail options day traders are unprofitable in their first year. The 0 DTE marketing shows you the 5-bagger. It doesn't show you the 4 contracts that decayed to 0 to fund that 1 win. Track your real win rate over 100 trades before you scale size. 100, not 10. So what actually survives? One strategy. 100 trades reviewed before you change it. Defined risk structures only. Long calls, long puts, verticals. A daily loss cap of around 3% of equity. A hard limit of 3 to 5 trades per day. Liquid underlyings only. A journal with screenshots. And here's the loop I opened with. The single most destructive habit in options day trading. Selling naked short options for premium. The upside is a few $100. The downside is theoretically unlimited on a naked call and very large on a naked put. One gap on one bad morning and the account is gone. Selling premium can work, but only inside a defined risk structure, the short leg of a vertical, the protected leg of an iron condor. Beginners should not sell naked, full stop. Here's the honest framing. Options are genuinely capital efficient. A $5,000 account can't take meaningful directional size in shares. It can take 5 SPY at the money calls and capture the same move at real leverage. That's the appeal. That's why retail keeps coming back. But options decay against you in a way stocks don't. A stock you hold for an hour costs you the spread. An option you hold for an hour costs the spread plus theta. For a trader with a sharp directional edge, options magnify the payoff. For a trader without one, they magnify the cost of being wrong. So the verdict. If your stock day trading is already profitable over a documented 100 trade sample, options can multiply that edge. If it isn't, options will not fix it. They'll accelerate the losses. Build the edge in the underlying first. Paper trade the strategy for 30 sessions. Then size up, slowly, on SPY or QQQ with defined risk and a written plan. The leverage comes after the edge, not before it.
Options magnify edge, they don't create it. Build it first. Full breakdown linked in the description.